Hey, my name is Chester Johnson. I'm the co-founder of the Stock Boss app, and today I have John Collins again on the program. John is a financial educator and is our resident guru when it comes to retirement planning. And today we have a lot of questions we want to ask him in depth about some retirement planning concepts. So, John, thanks for joining us today.
Thank you so much, Shasta. Good to be here again.
So, today we're hoping to talk about Roth IRAs. Uh, there's a lot of questions around it. People don't understand a lot of it. Uh, so there's a lot of detailed questions people have. But I guess for everyone out there, the first question obviously is, what is a Roth IRA?
Right. So I should have bought a whiteboard. Um, but it
Good point.
would, yeah, would have to backtrack to, well, what are retirement accounts? Okay, Roth IRA is one of several retirement accounts, and an IRA is an individual retirement arrangement per our IRS terminology. So most of us call it individual retirement account. Doesn't really matter. So it's, well, what are retirement accounts? And there are different options to think about. An IRA would be one of those options you have when you're thinking about preparing for retirement. Okay, so now when you think about an IRA or you think about most retirement account, think taxes. That's important because if you start to research about retirement accounts, well, most of your answers will be on the IRS website, not on an investment company's website. Yeah, they would, tell you a few things, but an investment company has a goal to be able to help you invest. The IRS, has several goals, and we're not going to go into that. So, individual retirement account, essentially, or a 401k or whatever, retirement account you're going to decide to use, I like to think about it as a vehicle. Okay. So what that means is, well, I have to first have a destination, and then I decide what kind of vehicle can get me there. And then I get into that vehicle, and then I head out to where I'm going. Okay. So it's not an investment. An IRA is not an investment, right? That gets a little bit deeper now to where, well, if I'm using this vehicle, what kind of gas do I need to put in there so that it gets me to where I'm going? And how often do I need to refuel? So conceptualizing that in that way kind of brings you down back to the basics, which is, where am I going? What kind of vehicle will be suited for that destination? Okay, so bring it back to taxes. Well, an IRA, a Roth IRA, 401k, SEP, all of these different retirement accounts have different tax treatments that for everyday people can be extremely complicated in some cases, which is, again, we talked about the need to understand exactly where you're going, your strategy, and work with a professional that can help you break these things down so that you find what's suitable for you. Okay, so an IRA is one of those vehicles that can help you get your retirement destination. And why you use an IRA versus another retirement vehicle should depend on, well, how do I want taxes to impact me either today or in future.
Got it. So if I can understand it correctly, uh, if my goal is to invest for retirement, I need some kind of vehicle to get there so that I can protect myself from a tax point of view. Is that kind of
Right.
how it looks like? Got it.
Yeah.
Oh,
Yeah, in a sense, right. And so because now think about, again, there's vehicles that have, let's say, instant gratification might be a good way to put it. So if I used an IRA, essentially I have these tax deductions that I might like. But then when that investment that I put into my IRA, when that investment grows, well, then I have tax implications in future. Then I would use a Roth because, well, I don't get those tax deductions today, but when that investment grows in future, I can take that investment, or as they like to put it, distribute it for my use without any tax implications. That's really where that tax plays a role as far as using an IRA as a vehicle to get to your retirement goals.
got it. So you say that it changes, based on whatever the IRS wants to do. But as of now in 2022, what are the contribution limits? And is there also an income limit? What does an income limit mean?
Okay, good. Great question. So right now for 2022, your contribution limit is 6,000. That would be the same across whether it's a Roth IRA. Well, it changes a little bit when if you're age 50, we have what we call a catch-up contribution that allows you to put in an extra 1,000 because you're catching up, as the term implies. So then, as far as income limit goes, generally speaking, it changes whether I'm married or single, married and filing jointly or single, or if I am already contributing in some other work provided retirement plan. Okay, so you need to understand those before you figure that what limit applies to you. Okay, so generally for 2022, if I'm married, filing jointly, and again, you can go to the irs.gov to find this. It will be $204,000 and 129 for an individual. Um, now those deductions or contributions to IRA will be reduced if I'm contributing in a different retirement plan, and that would have a range of about 109 to 121, 29,000 for a married couple, and 68 to about 78,000 for an individual or the head of a household. So those are the options. Again, based on your income or whether or not you're contributing in a retirement plan, it changes a little bit.
So is it possible that if your income's too high, you can't even contribute to a Roth IRA?
Potentially, yes. And these laws are
Hmm.
changing pretty quickly, especially with two different administrations, Republican and Democrat, and all of that. So you can usually go above that income limit if you're going to contribute in a Roth IRA. Obviously, the traditional IRA doesn't apply. So now there's different options. Again, let's go back to vehicle. Okay, there's if you and I had different incomes, would obviously drive different vehicles for the most part, right? So the IRS thinks that in exactly the same way. So if I'm an average income earner, well, we want you to be able to, have tax benefits in the future because obviously maybe you're not doing too well today. Well, if you're earning a lot of income, we want to take as much taxes as we can from you. So no, you can't use a tax advantage plan like a Roth IRA. Go try other options. So
Oh, wow.
right. So again, take it back to why an IRA is a tax plan, right? There's taxes that are due today depending on what you use as your investment vehicles. There's taxes that are deferred, which is, you could get tax deductions today, but you're going to pay taxes later. So essentially, your seed isn't taxed, but when that seed grows into an orange, then your orange is taxed. Now there's also options we call potentially tax free. Okay, so those are usually the three options I have when I'm building wealth. Whether or not this is retirement, there's going to be some kind of tax implication either now or in the future. So when I'm in a higher income bracket, I want to consider different options there are that have the tax benefits that I can take advantage of, and the Roth IRA might not be one of those. If I make over $200,000 or $125,000 for a if you're single, $129,000. Sorry, if I'm single. So that's kind of the range where I fall, and we can go into that in a different video where what are the options I have if my income is too high, and some of those back doors that, or again, new administration is looking at how to take some certain you know uh, backdoor options people have away. But again, it's important for you to consider what your income is, what your goal is, and to have the right strategy that helps you to get to where you're going.
Just to note for the next video, what would be in one sentence, what would be the suggested retirement account for someone with a high income?
So generally speaking, if you have a high income, there's different ways you can structure that situation. So if I'm high income earner, I could start a business to be able to take advantage of the SEP IRA, for example, that has $54,000 as the limit, and all of that is tax deductible. But there are tax implications in the future. Now, one of the more common options people use, that people in their high income bracket use, is after obviously they've maxed out their 401k, and Roth 401k, and they still have all this money to put away. Life insurance is a very popular option with high income earners.
Hmm.
And essentially, this goes all the way from everyday people like you and I to banks and financial institutions, which they tend to be the people that use life insurance the most, because generally speaking, the IRS has the most favorable tax laws for life insurance, right? So, which is, if I bought life insurance and I passed away, my family gets that money tax free. Well, what investment companies did over the years was, well, what if we could make it possible so that when I'm paying my life insurance premium, I also can save money in my life insurance. So let's say my life insurance is $20 a month. What would happen if I save $2,000 into that life insurance? Essentially, what happens is, well, in future, so if my goal is for retirement, all that dollar amount above my $20, which is the cost of my life insurance, I can take it out tax free, because life insurance isn't taxable, right? So that's what a lot of wealthy people and organizations do, like banks, and whatnot, to be able to stash away large sums of money and take it out tax free. And what the life insurance companies do as well is give you the opportunity to invest that money. So kind of like you would do in your IRA. So remember, your IRA is a vehicle. Life insurance is a vehicle as well. Health savings account is a vehicle. 529 is a vehicle. All of these terminologies are really just vehicles. They have no value until you put money into it, and then that money works for you, which is by choosing the right way to earn interest. Okay, so if I put money in my IRA and I just went into the website and just clicked on some random mutual fund I know nothing about, that earns only 1%, well, you're excited that you put money in an IRA. 30 years from now, you only made 1%. Essentially, you're going to get out exactly what you put in and lose money to inflation, right? So that's why it's a vehicle. It's important that if I'm contributing any retirement plan, that I understand exactly what options I have within that vehicle to grow my money. Okay, that's kind of how it works. So to answer your question, life insurance is the most common way to be able to grow tax-free retirement income if I'm earning well above $129,000 or $200,000 and onwards. And think doctors, surgeons, all of these people, they can't do
Yeah.
anything with their company provided plan. Some of them don't own businesses, so they have all this money, and a lot of investment options out there are risky. Life insurance, because insurance is a risk, um, technically a risk management industry, right? The risk of me dying is protected. The risk of me crashing my car is protected. They take on that same risk management ability and apply it to your resources, to where they can give you interest and returns on your money without you having to worry about losing it. So it's in some cases it might be fixed, some cases it moves with the market, but the point is I can put in as much as I want and take it out without any tax implications. Long answer to your short question, but
Yeah, I opened Pandora's box there. That was great.
I know, right? So don't put that on YouTube. Yeah,
Oh man. Okay.
yeah.
All right. Last question here. What is the 5-year rule for Roth IRAs?
There's actually a number of rules, but I think generally speaking, when people ask about the 5-year rule, if they're not thinking about inheritance, most times they're thinking about when they can start to make withdrawals. So generally speaking, I have to wait 5 years to be able to start to make withdrawals from my IRA. Now I know that, and if you don't know, you can start to make distributions. Distributions just mean taking that, and they have all these technical terms for some reason. But taking, you can distribute money or take money out from your IRA without penalties until you turn 59 and a half. So generally
Mm.
speaking, you can keep it there beyond the age of 70. Okay. So the 5 year rule means, well, just because say you're 40, 56, and you have all this money and you think, well, I'm just going to throw it into an IRA and then once I'm 59, take it out tax free. No, you have to have the 5 year. That's where the 5 year rule would generally um, apply. So you have to wait at least five tax years to be able to start to make withdrawals for Roth IRA contributions. Okay, and it
Perfect.
goes a little more complicated when we're talking about conversion from an IRA to a Roth and all of that. Again, a lot of these complications, I won't worry too much about them, and you can read on and on about this, but just understand that you have to at least wait 5 years before you can start to distribute, which is where the fundamentals come in, Chester. I don't want people to think, well, now I know what an IRA is, go open one. And then
Yeah.
I've run into financial difficulty in 2 months and I want to take it out. So I
See
usually
our, see
wouldn't
our
answer,
previous
huh?
see our previous video about why you need a financial professional.
Right. Because I want to make sure I get certain things right before I start. Um, so if I just rush it online and open an IRA, I'll get excited. I just did something right. But if I've ignored all the other fundamentals and not put it all into a strategy, then most likely, I only get excited for the first 2, 3 months of contributing. And we say that all the time. And then, you know, something else is going to excite me and I'm going to go do that.
Yes. Yeah. Make sure you have a full picture
Yeah.
of your retirement plan. Yes. Well, great. John, thank you so much for this. This was a wealth of knowledge. I learned a lot myself in the last few minutes. So thank you so much, John, and I appreciate it.
Thank you, Chester.
Awesome. Okay. Good.